Welcome to the National Real Estate Cafe with Don Getling and Gino Franti, where we explore an old adage that says what goes up must come down.
All right, so you've seen now that we just talked about it yesterday. I know you've seen the big stock market crash. Oh, or was it? It realistically was a correction that we were prepared for. But why did it correct? What was the fears? And believe it or not, it had a lot to do with rising interest rates, which we have not seen since the middle of 2014. Let's go to this first chart.
So what you're actually saying is that what goes down must come up.
There you go. So this chart, just so you know, is inverse. So this is called a bond chart. This is really what we watch to see where interest rates are going. A lot of you watch the 10-year note. That gives you a kind of an idea where the 10-year, what the 10-year Treasury is doing. But realistically, it's buying mortgage-backed securities. So we watch a chart like this on a regular basis, similar to stock charts. These are called candlesticks. So red means selling, green means buying. Red means selling. That means interest rates are going up, because if they're selling, that means we have to raise the interest rates to attract buyers again. So that's basically where we're at. And you can see that basically, since almost the beginning of the year, just after the beginning of the year, we've seen a decrease, and that has to do with fears of inflation, which erodes the value of bonds.
Nice. Okay, so that's definitely what it is. It's fears of inflation, which is actually a good thing. Inflation is not a bad thing. Interest rates going up is not a bad thing. That means we have a healthy economy. So with unemployment where it is, almost at zero, because 4% is considered full employment, and you also have layoffs at an all-time low, right? When you look at the ADP unemployment report. So you really have a strong economy. Rates have to go up to slow it down. This will prevent hyperinflation, which you definitely don't want to see.
Well, and they saw the inflation numbers that really scared everybody was finally we're seeing some wage inflation, because we've seen a lot of, we've gotten full employment finally. That was the key, is just getting a job and knowing you're going to keep your job. Well, now we actually have a tighter labor force, and therefore wages are going to start increasing some, which is again a good thing, like Gino said, for the economy. That's how we buy bigger houses and new houses and more goodies and toys, and all that increases inflation. So because of that, interest rates have been increasing.
So the concept behind that, Don, is that if you get a raise that's $5,000 more a year or $3,000 more a year, and your mortgage payment only goes up by $1,200 more a year, you can afford more goods, and it's okay to see interest rates rise.
All right, so when was the last time we've seen this? Here's a little chart to show you why it bounced the way it did. The last time we've seen the bond market this low was all the way back in the middle of 2014. So it's been a long time since we've had rates where they're at right now.
Okay, but if you go back a little further than that, you could see they were even higher. What was that, in like 13 or something like that? So that tells you that that doesn't mean that rates will stay high forever. They could go back down and change direction. Don't forget that we had a change in Fed chief. That also had something to do with this.
Right, and you can see that it bounced off this number back in the day, but I don't know if we're going to be seeing that in any time in the near future. Bottom line is, we warned you that eventually interest rates were going to start going up.
They have to, and it's a healthy thing. And wait, make sure you don't make this mistake. Don't think that because interest rates are rising, home prices will go down.
Oh.
That would be a critical error. We'll go over that more on another slide, another day, when we get the data for you. But we know that the last 4 times interest rates went up, so did home prices.
All right, you heard right here on the National Real Estate Cafe, where you can get these sent right to your phone by texting NREC to the number 58885, or find out more at donandgino.com.